we're already seeing around the margin central banks are buying more gold. So there's not been a ton of demand for like gold ETFs and things like that. So without central bank buying, we probably would have seen lower gold. But because there is a pretty big central bank bid, and that's partially inflation concerns, but I think a bigger chunk of that is confiscation concerns. Basically, that the moneyness of treasuries and dollars is at question if you're a country that's not in like perfect harmony with the United States.
In this insightful discussion, financial analyst Lyn Alden hints at a potential shift reminiscent of the 1970s when confidence in the dominant currency wavered. Drawing parallels, she suggests that in times of crisis, assets like gold and possibly Bitcoin become havens. Alden notes the current trend of central banks increasing gold reserves, driven not only by inflation concerns, but also by fears of currency devaluation. She implies a subtle move towards decentralization, emphasizing the importance of diversifying reserves, echoing historical events where gold experienced a significant surge. Alden refrains from predicting specific magnitudes, urging a focus on key drivers shaping the financial landscape.
Yeah, I think the close example would be the '70s. And if you put yourself in the role of the '70s, for the first time ever, the United States and the rest of the world was on a completely fiat currency standard. So it was like a new
Mm,
era. And a lot of people are saying this is never going to work. Um, and oil embargoes were happening, and money supply growth was above average, and inflation over time was kind of spiraling out of control. And so it resulted in a massive gold bubble. A lot of people piled into gold. Gold
right.
became a very large asset relative to equities, relative to the bond market, relative to the money supply. A lot of people poured into it, and it took like decades to kind of surpass that prior high in gold price. That's how big that got. So basically, that shows what can happen when the dominant currency faces a major crisis of confidence, and people poured into what is available, which in that sense was gold. In the modern times, it'd probably be a combination of gold and Bitcoin, depending on how old you are, what scale you're operating on, what you're researched on, things like that. We're already seeing around the margin central banks are buying more gold. So there's not been a ton of demand for like gold ETFs and things like that. So without central bank buying, we probably would have seen lower gold. But because there is a pretty big central bank bid, and that's partially inflation concerns, but I think a bigger chunk of that is confiscation concerns. Basically, that the moneyness of treasuries and dollars is at question if you're a country that's not in like perfect harmony with the United States. They say, well, at least I want a backup. I don't want to have 100. I don't want to have all my eggs in one basket. I want to have some of my reserves in like self custody in our central bank vault in our borders. And so I think that there could be a shift towards that. And that's where you get those types of nonlinear events, right? That's why I would
mm.
try to I wouldn't be like bold enough to say, okay, I think we're going to hit 12% inflation by this year, and then we're going to come back down. There's too many nonlinear things that can occur, and so instead, I just kind of keep track of the biggest things. There's the ongoing fiscal issue. There's the energy supply demand situation, and then there's other technology offsets, things like AI. And these are kind of the big forces that are coming at each other. And so on a quarter by quarter, year by year basis, I'm kind of seeing, okay, how big are these forces? Which ones are winning? Which things are surprising me one way or another? Which things are kind of on track, exactly how I thought? And so I'm very hesitant to give magnitudes. It's more just like focusing on these drivers and trying to give an under or an over. Like basically, if the 2020s, I expect to be a more inflationary decade than the 2010s, but magnitude, who knows?
Lyn Alden delves into the changing landscape of institutional finance, noting a growing recognition of fiscal dominance and concerns regarding ongoing deficits. Major institutions are increasingly addressing these issues, with internal reports resembling perspectives previously considered fringe. Alden emphasizes the present impact of fiscal challenges, attributing it to the combination of 40 years of rising debt to GDP and falling interest rates. Shifting the focus to a potential asset, she highlights a rational consideration for its allocation among institutions, emphasizing that serious pools of capital are involved. Alden also draws attention to the recurring cycles in the potential assets price chart, emphasizing the potential for another higher high.
Among institutions, I am seeing more of a recognition of fiscal dominance and concern around these ongoing fiscal deficits. And I have some of a biased sample because I often find out about this because they read my work. But for example, there will be major institutions that you'll know the name of, and someone will give me like an internal report, and it's like literally like it looks like something like me or Luke Groman wrote, and it's like major institution XYZ, this is like their report on the fiscal dominance problem. And I'm like, wow, okay, so that's things that were considered fringe or outside perspectives are now more normalized, right? So that's kind of the first part of this whole thing is like, is that happening among macro circles? Not all macro circles, but certainly around the margins, including at major institutions. I would say, yeah, there's an ongoing realization that these fiscal issues are not a multi-decade problem now, that they're actually starting to have material effects in the present. And that's largely because we've had 40 years of rising debt to GDP offset by 40 years of falling interest rates. And so if interest rates merely go sideways from now on, let alone up, but if they just go sideways, those deficits no longer have an offset, and that debt level no longer has an offset. And so that it becomes more spiraling, which has consequences. So that's kind of the first step. For Bitcoin specifically, I mean, there are, I talked to some bank boards that invite me to talk, kind of talk to them about Bitcoin or again, some of these fiscal problems. Um, there are institutions that, think it's rational to have an allocation. Sometimes you'll see people that are not in the ecosystem are like, oh yeah, Bitcoin's all the millennials, just kind of, they'll kind of mix up Bitcoin and crypto and just kind
Hmm.
of put it all in one basket and say, oh, that's what the crazy kids are doing. And it's like, well, you should see the people allocating to Bitcoin venture because, these aren't kids.
Hmm.
At least most of them aren't, and these are serious pools of capital, and so there is a increasingly, I think, aware perception. And the way that I phrased it, I was doing a fireside with Preston Pish, and I pointed out that we've all seen like the logarithmic Bitcoin chart. How I forget how many peaks and troughs it's had now, but we see all those peaks. You have to remember that the vast majority of people in the world have not seen that chart. In fact, I remember the first time I saw that chart. I never looked at Bitcoin's price in logarithmic form before. I'd always, when you look at it in linear form, you see one of two things. It's either in what appears to be an insane bubble, or it appears to be a broken bubble and it's dead.
Hmm.
It rarely looks like anything other than those two. Whereas when you look at it in logarithmic form and you go back and study, okay, what was happening during these highs and lows each time, you see this recurring cycle. And it's done this like three times, three times it's had a higher high after a 75% drawdown or more, sometimes like over 90%. And there's a handful of stocks that have done that, but I haven't found any stocks that have done it more than three times. And so if Bitcoin has another higher high, it'll be like the fourth time it's done this. Um, and but what we have to keep in mind is that again, most people have not seen that chart. And instead, what most people see is only the ones that were happened while Bitcoin was big enough for them to be aware of it. So, for example, they saw the 2017 spike and then the crash, and then they saw the 2021 spike and crash, the higher high, higher low. So they've seen two, right? And so they think, okay, there was a bubble, and then there was a stimulus bubble, and then it's dead. That's how a lot of people saw it. Whereas if those of us more in the space are saying, no, no, this is still going strong under the surface, when they see like a third higher high and maybe a third lower low, and that's where it becomes impossible to ignore because it's not just how many times Bitcoin's done it, it's how many times they've experienced it happen.
In today's discussion, Lyn Alden provided valuable insights into the evolving financial landscape, drawing parallels between the current economic climate and the challenges faced in the 1970s. She emphasized the potential significance of a shift towards assets like gold and a potential asset, echoing historical events. Alden also shed light on the increasing recognition of fiscal dominance and ongoing deficits among major institutions. As we navigate these complex financial dynamics, it's crucial to stay informed about the forces at play, such as fiscal issues, energy supply demand dynamics, and technological advancements like AI. Lyn Alden's cautious approach towards predicting magnitudes encourages us to focus on understanding the driving factors shaping the financial landscape. If you found today's insights valuable, don't forget to subscribe, like this video, and share your opinions in the comments section below.